As we just reported, Treasury Secretary John Snow saying the U.S. economy is healthy. In fact, he says it should grow by more than 4% in the coming quarters. For a look at what this means for the stock market and your investments, we're joined now by David Edwards, president of Heron Capital Management. Welcome to the show.
Good morning.
So overall, what is your sense of where the market has gotten to and where it's going? I know you have some real specific models you want to look at, but just give us your position right now, David.
We've had 6 months of the year so far where the markets have gone nowhere. We see a hard floor of 10,000 on the Dow and 1,100 on the S&P 500 and 1950 on the NASDAQ. Not a lot of downside risk, maybe 2%, 8% upside risk by the end of the year.
Okay. Well, let's get started by looking at the Federal Reserve model. Before we pull up the charts, though, tell us what the Fed model is, what we're going to look at, and why it's important.
Right. This is a forward-looking model based on one-year forward expectations of interest rates and corporate earnings. It's not a day trading model. These are quarterly data points. But if you look at it back to 1918, as we have, you often see that it's a good situation for it.
And okay, we've got it on the screen now.
Right.
And so explain us what we're seeing.
We're looking at it back to 1987, and I took it to 1987 because that previous bubble that we always think of, the model only showed the market about 30% overvalued, followed by a 20% undervaluation.
Okay, I don't think people really understand what they're looking at, so let's really break it down. We've got the yellow line, we've got the white line. Tell us what they are, and tell us what it means when the white line is above the yellow line,
right,
or the yellow line is above the white line, because I don't think our viewers really understand what you're talking about.
When the white line is above the yellow line, that means that the stock market itself is much higher than the fair value indicates.
Okay.
So the best place to look is 1999-2000,
okay, when
there was about an 80% gap between what the fair value was and what the actual value was. 3 years later, you have a 40% gap in the other direction. The market is 40% under what the fair value says.
Okay, and so what's within that model? You said it's interest rates, corporate profits, and somehow where interest rates are relative to profits, that basically tells us whether the market's undervalued or overvalued?
It all boils down to discounted cash flows. The S&P 500 represents an earnings stream, money coming to you over time through both earnings and dividends, and there ought to be a fair value of what that ought to be based on what interest rates are right now.
Okay, and now we're taking a bit closer snapshot to really underscore. So now explain what we're looking at.
Last 3 years, this shows how far the market was overvalued, up to 80% overvalued, versus where it is now. It's currently 30% undervalued. It was 40% undervalued a few months ago.
Well, let's just stop. I mean, I think a lot of people would say undervalued. What are you talking about? A lot of the PEs are very high. You know, we've come back pretty far. Why do you? I mean, when you quite apart from what that chart says, why do you believe it's undervalued? Is there that much potential for these companies we haven't seen yet?
Yeah, actually, we will see some pretty solid earnings coming up in about 3 weeks, plus 15%. But historically speaking, a high PE is okay in a low interest rate environment. And now that we've backed up to 4 3/4 on the 10-year, which is the driver to this model, we can still see that the earnings are undervalued.
Interest rates are expected to move even higher, though, so isn't that going to take some steam out of your argument?
On the short-term basis, you'll see probably a Fed move
June 29th, 30th, quarter
exactly.
point, then maybe another quarter point.
Exactly.
Okay.
But the model is driven by the 10-year Treasury because that's where corporations borrow, and we've already seen a move 3% to 4 3/4.
And it's been a big move. And there are people who don't think it'll go much above 5%, but there are people who think the 10-year note could go much higher, 5.5%, maybe even 6%. Why do you think it's not going to go any higher?
No, we think 5% by the end of this year, and it could go 5.5% sometime the following year as the economy continues to do well.
Right.
Even so, a 30% gap between fair value and current value is a good place to be.
So this is a good, okay, so this is then basically, overall, you're pretty positive on the market.
We are fully invested.
Okay, well, that's a positive signal. REITs. Now, REITs have been beaten up. People, I think, on the face of it would say, you know, real estate investment trusts, all that kind of very interest rate sensitive stuff in there is going to suffer in an environment where we're going to be in steady rate rises for Lord knows how long, a year, year and a half, or what?
When I was here in early May, we touched on REITs briefly. I said, look, you have a 24% sell-off in REITs April through May in anticipation of higher rates. And I say we'd be looking at it pretty closely over the following months. And that bottom downtick there is when I was last on the show. Since rallied about 15%. Wow. We look at REITs not only in terms of potential appreciation, but also in terms of the current dividend yield, ranging from 5 to 10%, depending on which one you're in.
So do you think that chart is going to continue to move up?
I think it will stabilize or go higher.
Okay.
But in an environment where we think 8% is a fair return in the S&P 500, getting a 9% dividend yield is not bad to look at.
Okay.
And unlike bonds, REITs have a little bit of an inflation hedge because if inflation picks up, so does the value of the underlying properties.
Okay. So let's look at some of the particular REITs you want to look at. And Vornado is one of them?
Right. We like Vornado. The only REITs we're a little anxious about are single home residential REITs because we think that market is overvalued. The office market, which represents Vornado, is much more sensibly priced, 5.5% yield, and geographically diversified.
Okay, and that's a ticker symbol VNO. We've also got ADC.
Right, shopping malls. We think the consumer will continue to go out and buy stuff, and shopping malls get a kick not only from rent, but also from a percentage of sales. And that yield is 8.0.
Okay, and how about Crescent Realty?
Apartment buildings, not single-family homes. Again, geographically diversified, 9% yield.
Okay, so beyond REITs, which you made the point that you made the point when you were here last time. We should have listened that the REITs were so beaten up. That
it was 10% in a month. Yeah. That's not bad.
So, what other sectors? Is there any opportunity you see like that right now for people, David?
You know, one of the areas that we spend a lot of time thinking about is the future price of oil. And right now it's about $37, $38 a barrel.
Right.
It could get down to 30 if the terrorist premium evaporates. It could go up to 60 or 80 if the terrorists succeed in shutting down Saudi Arabia, for example. So we spend a lot of time scenario planning with the stocks in our portfolios to figure out what we would do if oil became 30, what we would do if it became 60. If it became 30, you'd probably take profits on your major oils like ExxonMobil. If it became 60, you'd probably go out and buy Schlumberger, Halliburton, the drillers, and you would abandon your airline stocks and your car companies. If it became 80, we'd start looking into alternative energy developers like corn to biofuel, which is a kind of a private venture market now, but we think will be significant 5 to 10 years from now.
Absolutely. Biodiesel, I guess, is one of the products that people are making that's really getting some attention. David Edwards, you always give us fuel for thought. Thank you so much for joining us. Hope to see you again soon.
Okay.
This is CNNfn, the how-to network for all things money.